Also today, we had a full discussion of the options around quantitative easing, not quantitative easing, the asset purchase program. And, we understand the ways in which we can adjust the parameters of it to deliver more accommodation if it turns out to be appropriate. Right now, we think that this very large, effective program is delivering about the right amount of accommodation and support for the markets. And so it continues.
Thank you. Craig Torres, Bloomberg.
Hi, Chair Powell. First, it's great to see you're okay and healthy. Chair Powell, what is the risk that we come out of this with lower productivity, weaker labor force attachment, slower growth, and important for your tools, Chair Powell, a cycle of lower real interest rates? And if you think this type of scarring is a risk, then I'm wondering what's stopping the Federal Reserve from having a more explicit dialogue with Congress about the particular types of fiscal support we might need to avoid this outcome, to make sure that you push away from the zero boundary, or that the economy does, when we exit this. Thanks.
Thank you. So you laid out nicely the risks of damage to the supply side of the economy, or scarring, as you put it. And we've been talking about those since the very beginning of the pandemic. The risk is that, for example, people are out of the labor force for an extended period of time. They lose their attachment to the labor force. And it's harder to get back. Your skills atrophy. It's harder to get back in. And the record is, if you don't get back in fairly quickly, it can be harder to get back in. And that holds down the whole economy. And by the way, it places enormous burdens on individuals who may have this happen to them at an important stage in their career. So it's important. And, so that is one of the reasons why our response was so strong and so urgent at the beginning, and why we've called this set of risks out. I don't know how we could be much more vocal about it than we have been. Fortunately, for the economic recovery has exceeded certainly the downside cases that we were very concerned about, and even exceeded the baseline expectations. Now, that's so far. We are a long way from our goals, and we're sort of halfway there on the labor market recovery at best, and there are parts of the economy where it's going to be hard until there's a vaccine. The parts of the economy. So, that's the supply side damage. That's sort of the third thing that we talk about. The first, at the beginning, it was to provide relief and comfort. The second part was to provide support to the expansion when it came, and the third was to avoid longer run damage to the economy. And that's all of these things. I think we have been vocal. We'll try to continue to do that. And that's again, that goes to keeping this episode as short as it can be and avoiding unnecessary business bankruptcies, unnecessary household bankruptcies, and unnecessary long-term stays of unemployment, or supporting people through them so that they can maintain their financial footing in their lives and be able to go back to work in a productive way. It's very important that there is a real threat here of those things, and we're trying to do everything we can to minimize that threat.
Look like, and whether you anticipate any consequences if they are not extended.
Yes, thanks. So first, let me say we do think that the facilities have generally served their purposes well, particularly in supporting the flow of credit, particularly acting as backstops to private markets. So overall, we think that the programs have gone well. In terms of the extension, we are just now turning to that question. We've had a lot of things to work our way through. Right now, we're just in the process of turning to that question and have, of course, not made any decisions. And in terms of the process, this is a decision that, of course, we have to make and will make jointly with the Treasury Department.
Shepard Smith here. Thanks for watching CNBC on YouTube.